Hello and welcome back to the note. Today I'd like to take a look at the theory that dividends don't matter, as it's evident from my email inbox that a lot of people find this theory really very disquieting. Now, it comes from a Nobel Prize winning insight known as the Miller and Modigliani theory, or universally in the trade as M&M. It looks at the different choices that companies can make with their cash, and ultimately you can choose between paying out in a dividend, buying back shares, investing in something, or just leaving it sitting in the company as retained earnings. Now, Miller and Modigliani, M&M, make a number of very restrictive assumptions that don't always exist in real life, such as that taxes are all the same and that there's no difference in transaction costs. But making those assumptions, let's take a look at what happens when a dividend is paid out by a company. Say it pays out $100 million. That $100 million is distributed as cash to investors, but the retained earnings in the company drop by $100 million. Now, those retained earnings also belong to the investor, so their value, the value of their investment in the stock, has dropped, in theory at least, by as much as they have received in cash. Therefore, it should not make any difference to an investor whether a company pays a dividend or not. If they happen to need income, the M&M response would be well, you can just sell some shares. Now, for many years, people really took this idea very seriously, and dividend yields fell very low on stocks. However, even if the theory is very clear that at least in one sense dividends shouldn't matter, in practice it's obvious that they do. What we're looking at here is the result of research looking at UK stocks going back to 1900 by London Business School. We'll take a look first at how low yielding stocks did, then we'll take a look at how the average for the index did, and now finally we'll take a look at how high yielding stocks performed. So you can see plainly that over history, investors very much rewarded, very much did benefit from companies paying a higher dividend yield. Further, in the long run, the value that we get from stocks is very much wrapped up in the dividends that were paid out. This is research from the US, also from London Business School. This is the capital gain that you'd have made on the US stock market starting in 1900. This is without taking any of the dividends into account. And now let's take a look at what we would have done if you had taken dividends and reinvested them. Plainly, dividends make a huge difference to the value that we ultimately gain from the stock market. Now, that might seem to be an insuperable evidence that we do need to take dividends and dividend yields very closely into account whenever we're investing. But there are some cautionary tales to be made here. Companies have a life cycle, generally speaking, early in the cycle when they're small, growing, investing what cash they have, they won't be paying a dividend. By the time they are paying a dividend, they will be larger, more boring companies which have less interesting things to do with their money. If you want a classic example of this, let's look at Microsoft, one of the most successful companies of all time. This is how Microsoft's share price performed from its IPO onwards. And now let's take a look at their dividend paying history. And you can see that all their dividends started to be paid out at a point long after Microsoft's peak had been reached and it had essentially become an ex-growth company. If somebody had been waiting for dividend yields, in that case, they would have missed out on all the excitement, all the wealth being generated by Microsoft. That logic adhered for a long time and perhaps was taken to extremes in the 1990s during the tech bubble, when a dividend yield was almost seen as a negative for a stock. That, as we can see from the long-term data, was an extreme situation. But in the last few years, dividend yield has trumped more or less all other factors, and I would like to argue that that is also an extreme position. It's partly because of low bond yields, meaning that people will look to equities for a yield in the way that they haven't done before. It's also because of an extreme lack of trust. Dividend investing, as I've said before, is the ultimate show me the money kind of investing. If you don't trust a company, then seeing that they've actually paid out a dividend is a very good way to be sure that there is some real money being made there. It's a discipline on them to stop them wasting your money, even if it's also, of course, a discipline to stop them investing in ways that could have been productive. Therefore, it is not ridiculous to suggest that, at least in a sense, dividends don't matter. Over history, it's obvious that yes, they do matter. That's obvious from behaviour, but they don't matter, or at least shouldn't matter, as much as people have treated them as mattering in the last few years.